people. Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. So please be careful. Don't get yourself scammed. If you want to follow me when I'm not on YouTube, I'm going to ask you guys to go down to the description box. Click on that Richard Fain Millionaire Mentor Instagram link and give me a follow on Instagram. If you're already rocking with Instagram and using it on a daily basis, you might as well go ahead and rock with me too. Follow me on Instagram and then send me a DM to let me know you're rocking with me. And so that I can say thank you. I really want to get my new Instagram page up. So right now we're about 3,400 followers, which is a lot less than what I had on my old Instagram page where I had 90,000 followers. So I know a lot of those 90,000 followers on Instagram on my old page that was disabled. They probably don't even know I got the new page. So that's why every day I'm telling people on the YouTube channel about the new page, because I know a lot of those people, those 90,000 folks, they don't even know that the old page is shut down, right? They just don't know. So I'm telling you guys every day on the YouTube channel so that I can hopefully capture some of that 90,000 Instagram followers I used to have on the old page, and I can get them over to the new page. So that's why I'm doing it every day, for you guys to understand why I'm doing it every day. That's because I'm trying to make sure I get people over to the new Instagram page. So if you want to follow me on Instagram, see what I'm up to when I'm not on YouTube, get down in the description box, click on that Richard Fain Millionaire Mentor Instagram page and give me a follow, then send me a DM to let me know you're rocking with me so I can say thank you. The next thing is the website. I've had the website for about a month, and over 100,000 of you guys have already visited the website. A lot of you guys have made an investment in yourself and purchased some of the digital products. Every day, people are purchasing the digital products, making an investment in themselves to help themselves get to financial freedom. See, the digital products really are a gateway to financial freedom. It also is a way for you to collapse time frames so that you don't have to go out and do all the work yourself. I've done the work for you, and I've put them in these 10 digital products, everything from credit repair, credit restoration, to increase your credit score, how to invest in the stock market, how to use the drip investment method to reinvest dividends to grow your wealth, everything from millionaire mindset, financial budgeting, how to set up a budget to make you a better money manager. That's in there. What else is in there? Oh, how to invest in real estate with little or no money down. That's in there. What else is in there? Oh, how to start an online business. That's on the website. How to grow an existing business, how to scale it. That's on the website. So we got 10 digital products, man, and they encompass everything that I talk about on my YouTube channel. So if you want to make an investment in yourself, get over to the website, www.richardfain.net, which is the second link down in the description box. So when you go to the description box, it's the second link, www.richardfain.net. Get over to the website, check it out. Grab yourself some of them digital products, make an investment in yourself, get yourself to financial freedom. And the reason that's important is because what we're going to be talking about today, guys, we got to wake up here in the United States. This debt thing is getting out of control. And the Federal Reserve has said that. It's getting out of control. But I tell you what, if you don't have no assets, you don't have no wealth, you're going to be in trouble. You're going to be in trouble. So get over to this website, grab these digital products, and get yourself in a position where you can execute and get to wealth. Also, one step further, if you're somebody that says, hey, I want to be mentored, Richard. I want to be a part of a mentorship group. I want to be a part of your mentorship group. You can. All you got to do when you go to the website, there's going to be a yellow button there that says, if you're on your phone, it's going to say join today. If you're on your desktop or your laptop, it'll probably say membership. Either way, click on that button. That'll take you over to my Discord where you can sign up and join the paid mentorship group or mentorship club that I have. We just finished our third 90-minute private live stream last night, and it was great. That's where my mentorship club members are able to have a private 90-minute one-on-one with me. Outside of YouTube, can't know anybody get into it. It's private, where they get to ask me their financial questions, and I get to use my 30 years worth of financial experience to help them get to the pot of gold at the end of the rainbow. If you want to be a part of that club, guys, you got to sign up through the website, www.richardfain.net. If you want to be a part of the mentorship club, where it's just us, and I'm in there all the time, guys, in the Discord. I was in there this morning. I'll be back in there this afternoon, tonight. I'm in there all the time because, see, these people in the mentorship club, when they send me an email or they direct message me, I answer because I'm their mentor, right? And I don't mind that. A lot of people may not like that word mentor, but I do. I have mentors. I think we all should have mentors. Nothing wrong with that. We all should want to have somebody that is already successful and done what we're trying to do. That's what a mentor is. It's just an everyday person. It don't have to be some celebrity. It don't have to be some famous person. It could be anybody that you can look to and say, you know something, that guy or that gal is doing what I want to do. They are where I want to be. They have the characteristics, the financial moral values that I want to have in order to get to my pot of gold at the end of the rainbow. They have done what I want to do. That's what a mentor is. That's what I am to all of these folks that are in my mentorship club. And we help one another. I'm not the only one in there helping. We're all helping one another. We're a family. You want to be a part of that family, man, get over there to the website and sign yourself up for that mentorship club. I'm telling you guys, we're doing a lot of big things over there, and we're going to continue to do a lot more big things. So be a part of it. The last thing, and then we're going to jump into the meat and potatoes. The last thing is Moomoo. Now, Moomoo is my self-directed brokerage app that I'm going to be using for the next 10 years to be buying paper assets. Every day, every month, every year for the next 10 years. What's my goal? My goal is to double my net worth. So whatever my net worth is today, I want to double it in the next 10 years. And I'm going to use the Moomoo app to do it. Now, the Moomoo app is my preferred app of choice. So if you want to rock with me and you're looking for a good self-directed brokerage app, that they ain't gonna charge you no fees, it ain't gonna be no monthly maintenance fee, there ain't gonna be no commissions for trades, hey, consider the Moomoo app. It's the first link down in the description box. Here's the nice thing. If you sign up using my link, they're gonna give you 10 free fractional shares of the Magnificent 7 stocks. You do know who that is, right? You do know who the Magnificent 7 is, right? And if you don't know, wake up. They're only the hottest, most valuable 7 companies in America. Tesla, Microsoft, Apple, Meta, Amazon, Alphabet, Nvidia. Tomorrow, Nvidia is having their fiscal year first quarter earnings report. It's expected, man, that these guys are going to kill it for the fourth quarter. And it's also predicted they're going to add over $200 billion to their value just tomorrow. I don't know if that'll happen or not, but guess what? I'm in it to win it. I got my brokerage account. I'm in this thing to build wealth. That's the only way I'm gonna avoid what I'm getting ready to talk about today is building wealth. So if you wanna build wealth and use the brokerage app I use, get down to the description box, click on that Moomoo link. You gotta put $100 in your brokerage account. That's the qualifier. It's not, you're not paying Moomoo $100, you're not paying me $100, it's your $100. But if you want the 10 free fractional shares of the Magnificent 7 stocks, you gotta put $100 in the account. My recommendation is put more in and start buying assets to build yourself some wealth. Because without wealth, you're gonna get trapped in this debt thing that I'm getting ready to walk you through. It's terrible and it's getting worse. So you better get you some assets. You better get you something that produces income just in case you can't work. You better get you something that's gonna take care of you. And just in case you get sick, you better have you some assets. I'm just telling you guys, get down to the description box, click on that Moomoo link, go get that free stock, go get that free money. I'm not sure why anybody would pass up that opportunity to get 10 free fractional shares of the Magnificent 7. I don't know. I don't know. Why would you pass that up? You shouldn't be passing it up. Get down to the description box and let's get to work. Well, all right, man, let's dive on into these meat and potatoes because, boy, look at here. We got something to cover today. I tell you what, man, the Federal Reserve of New York, they did a household debt and delinquency rate study. And it's shocking. It's shocking what the American people have trapped themselves under when it comes to debt in this country. I mean, it's shocking. And here's the sad part about it, guys. It's just gonna keep going up. You do know our country as a whole has about a $34 trillion deficit. $34 trillion debt, not deficit, but debt. When you look at the country's debt, it's 34 trillion. But when you look at the debt just for the Americans, take out the government, just the American people. When you look at the American people's debt, it's not good. It's not good. It's not good. So the Fed, the New York Fed came out with this report. It's the Q1 report for 2024, for the first quarter of 2024. And here's what the findings are. And then we're going to talk about some solutions. The Federal Reserve Bank of New York's Center for Microeconomics Data today issued its quarterly report on household debt and credit. The report shows total household debt increased by $184 billion in the first quarter of 2024. Guys, I don't know if you really understand what $184 billion is, but that's a lot. That's like 2 Jeff Bezos. That's like 3 Warren Buffetts. It's a lot. It's $184 billion in 1 quarter. Increase. Guys, this is not sustainable. We can't sustain this level of debt in this country for the American people. Jeez, it's just heartbreaking how people are just in positions where they continue to run up debt. And why do they continue to run up debt? Because they're not planning right financially. They're in financial bad shape. They're living on more than what they make. That's why. The report shows total household debt increased by $184 billion in the first quarter of 2024 to $17.69 trillion. Do anybody know what $1 trillion is? We got almost $18 trillion in debt. Just the American people, not the government, you and me. Yeah, almost 18 trillion. The report is based on data from the New York Fed's National Representatives Consumer Credit Panel. The New York Fed also issued an accompanying Liberty Street Economics blog post examining credit card utilization and its relationship with delinquency. See, not only do we got about $18 trillion in debt, a lot of it is delinquent. What does that mean, Richard? People not paying. That's what delinquent means. I'm 30 days, 60 days, 90 days delinquent, 120 days delinquent. Yeah. Not only do we got $18 trillion in debt, which leads the world, by the way. The $18 trillion in debt leads the world. There is no other population of people in the world that have more debt than the people in the United States. But we're in this fabulous economy. Everything's wonderful. No, it's not, guys. The New York Fed says different. The New York Fed says we're in trouble, serious trouble. Let's keep moving. Let's keep moving. Let's keep moving. The quarterly report also includes a one-page summary of key takeaways and their supporting data points. In the first quarter of 2024, credit card and auto loan transactions, start that again. In the first quarter of 2024, credit card and auto loan transition rates into serious delinquency continue to rise across all age groups. So not only it's across all age groups, that's just young people. That's young people just starting out. They got all that debt. No, this across all age group, guys. You got the young ones, the middle-aged ones, and the old ones across all age groups. So it ain't just one age group, it's all of us. It's all of us. In the first quarter of 2024, credit card and auto loan transition rates into serious delinquency, transitioned into serious delinquency, continued to rise across all age groups. Within the household of Public Policy Research Division at the New York Fed, an increasing number of borrowers missed credit card payments, revealing worsening financial distress among some households. See what I told y'all about that credit card debt, right? I told y'all what's going to happen. That credit card debt, as you keep balances and those credit card interest rates continue to skyrocket, at some point you're not going to be able to pay them. And that's what you see happening. See, a couple days ago, maybe last week, I did a report on how the credit card companies are starting to get smart because, see, Joe Biden and the Biden administration, they want to come out with this policy on the credit card companies where they can only charge so much for a late fee. See, now credit card companies will charge you $35 when you're late on your payment, right? Joe Biden and his administration want to bring that down to $8, from 35 to 8. So what do the credit card companies do? They say, okay. You want to reduce our late fee to $8? Guess what we're going to do? We're going to jack up their interest rate to 39.99%. So if you miss a payment, you're going to 39.99%. That's what's getting ready to happen, guys. See, these credit card companies don't care anything about you at all. All they care about is the good old greenback, the good old dinero. Mucho dinero. That's all they care about. They care nothing about you. They don't care nothing about me. So you think they care if they run you up to 39.99? They don't care. They're about making money, man. This is the United States. We're a capitalistic society. It's dog eat dog. You eat what you kill. Credit card companies don't care anything about you. So they're already saying an increasing number of borrowers missed credit card payments, revealing worsening financial distress. What's worsening financial distress? That's when you're living on more than what you make. I'll break it down to simplest terms for you. Financial distress is what happens to somebody who is living on more than what they make. You start getting stressed. Because guess what? You're looking at the paycheck and you're saying, paycheck ain't enough. Paycheck ain't enough. You're looking at the credit cards and you're saying, I'm maxed. So what do people do? They get backed into a corner and then guess what they go do? They make the worst decision of their financial life. They go to a payday lender. That's the worst decision you can make when you go to a predatory lender like a payday loan lender or a payday lender, where now you give these people access to your checking account. Guess what? They get paid before you get paid. And oftentimes, 300%, 400%, 500% markup. But when your back is against the wall and you can't go to your credit cards because you got no more limits, you don't have no more money coming in, you haven't planned properly, now you got to go to this payday lender, this predatory lender. You think the credit card companies don't care anything about you. Have you been to a payday lender? Yeah. They basically take control of your checking account. They get paid before you get paid. They don't care if your children are hungry. They don't care if you can't pay your rent. They don't care if your lights just got turned off. They don't care. That's why you got to care. That's why you got to put things in place financially to not getting yourself in that situation. And a lot of Americans are in that situation. That's the sad part. Well, let's keep reading. Mortgage balances rose by $190 billion from the previous quarter and was $12.44 trillion at the end of March. So we got $12.44 trillion in mortgage debt. Here's the question though. That's just the mortgage debt. Here's the real question. How many of those mortgages with a property attached to them, the property is worth less than the mortgage? See, that's what you got to ask yourself. How many of those loans have a balance more than what the property is worth? How much of that 12.44 trillion in balances, mortgage debt, it's probably more than a lot of these people's homes are worth. Now, if you bought pre-pandemic, you're probably good. If you bought in 2020, if you bought in pre-pandemic or 2020 or first part of 21, you're probably good. But if you bought at the height, you're probably underwater right now. You are. If you bought your property in 21, 22, 23, 24, you're probably underwater. You probably owe more than it's worth. Why do you say that, Richard? Because you got to understand how the housing market works. It works off transactions. The more people are buying properties, the more demand there is, the more prices tend to stay where they're at or go up. When you are in a situation we're like in right now in our housing market where we don't have very many transactions, prices are kind of stable, but guess what? There ain't enough transactions there is not enough demand to drive up anything. So what's happening in a lot of markets, even in the state of Florida, what's happening is it's starting to fall a little bit. Even out here where I live at. 6 months ago, my house was worth $100,000 more than it's worth now. 6 months ago. It's less now. It's around basically what I paid for it. 6 months ago, I was like $150,000 over what I paid for it in value. Now it's down to about what I paid for it. Good news for me is I put a big chunk of money down and I got reserved money, so it don't bother me. I'm not worried about making my mortgage payment. I'm in a better financial position than a lot of folks. But that's what's happening around the country with these mortgages, especially if, like I said, if you bought mid-21 or later, you paid at the height of the market probably. So that's where we're at on mortgage balances. They rose by $190 billion. Now mortgage balances are $12.44 trillion. Balances on home equity lines of credit, HELOCs. HELOCs now. Well, we just talked about the 12.44. We just talked about what? Mortgage balances. Now we're talking about HELOCs, that second mortgage line of credit. Balances on home equity loans of credit increased by $16 billion. See, guys, you got to understand these numbers we're talking about here. We're talking about catastrophic numbers. I mean, when you're talking about 12.44 trillion, that's a lot. That's a lot. You're talking about 16 billion in 1 quarter. That's 1 quarter. It rose by 16 billion. Now, why would you think equity lines would start increasing? Because people are tapping into that equity in their house to live. They're tapping into the HELOC so that they can pay for the lifestyle. That's what I think. I think they're tapping into the HELOCs, tapping into that equity, chipping away at the equity. That's why I tell y'all all the time, these dead assets, these houses, they mean nothing until they make income for you. Here's the thing though, most people, whatever profit they would have had, they're gonna exhaust that profit because they have to live. So they're taking the equity now through the HELOC to pay bills, to put food on the table. 16 billion increase in HELOCs in 1 quarter, representing the 8th consecutive quarterly increase since Q1 2022. What did I tell you? What did I tell you? Since mid-21, boy, it's not been good. This is the 8th consecutive quarter of increase. I keep telling you why it's increasing, because that's how people are taking care of themselves. They're tapping into the equity. The problem is, if you do that over a sustained period of time, ain't no more equity. So all of us that got our net worth tied up in our house, that's our biggest asset for most Americans. That's where we keep our wealth. A lot of people's backs are against the wall. Now they're starting to use that wealth. Problem is, if you do that over the next 5 years, where you're chipping away at your equity, before you know it, you ain't gonna have no more equity. You're gonna have an upside down property where you owe more on the mortgage than it's worth. Be careful, guys. Be careful with those equity lines, using them for things that you shouldn't be using them for. Be careful. It don't catch up to you till it catch up to you. And now standing at 376 billion. Wow. Balances on home equity lines of credit, HELOCs, increased by 16 billion, representing the 8th consecutive quarterly increase since Q1 2022, and now stand at 376 billion. Credit card balances increased by 14 billion to 1.12 trillion. We got over $1 trillion in credit card balances. Again, guys, we lead the world. There is no first world country in the world that has more credit card debt than us. Not one. See, in some of these other countries, they got different values when it comes to money and things that they buy. They have a better grip on necessity over want. Need over want. We don't have that here in America. Why? Because our system isn't set up that way. See, our system in America is set up for 99% of the people to buy all the stuff, to make 1% of the people wealthy. That's how our system is set up. Everybody's system in the country, in the world, is not set up that way, but that's how our system is. It's a unique system. It's a genius system, honestly. If you think about it, it's a genius system. You get 99% of the people, 99% of them, to do all the work, spend all the money, so that the 1% can have all the wealth. That's ingenious. And guess what? We're okay with that here in this country. Most of us are okay with that. We're okay with it. Okay. Most of us are okay with that, which is sad. Which is sad. We got to get out of that mentality. We got to get the mentality that, listen, I'm all for people doing what they want to do. You can come to this country and get rich and get wealthy if you want. I love that about our country. But so many of us who live in this country don't take advantage of that. We don't take advantage of all this opportunity here. There is so much opportunity out here every single day. We just don't take advantage of it. I don't have to make up numbers, guys. Go out and do your own research on the internet. I mean, I ain't got to make up these numbers. You got 150 million Americans don't even have retirement savings. They don't have no retirement. 150 adult Americans. We only have 350 million people in this country, including kids. So if you take 50 million kids out of the equation, you got 300 million adults. Half of them have no retirement savings. You got 70% of people right now living paycheck to paycheck. But you always got people who think they know more than what's really happening. And they ain't even at wealth themselves. That's the part about YouTube that's comical to me. You get these people that come in these videos and they make comments and they don't even have no wealth. Ain't got a pot to piss in or a window to throw it out of, but they got all the sense. They got all the knowledge though. Ain't got a pot to piss in or a window to throw it out of, but they got all the sense. I tell you, man. I tell you. So let's move on. Credit card balances decreased by 14 billion to 1.12. Other balances, which include retail cards and consumer loans, also decreased by 11 billion. Auto loan balances increased by 9 billion, continuing the upward trajectory since 2020 and now stand at 1.62 trillion. So you had a downtick in credit card balance, credit card debt. You had a downtick in retail cards and consumer loans, but then you had a uptick of $9 billion in auto loan debt. So now auto loan debt stands at 1.62 trillion. Credit card debt stands at 1.12 trillion. Both are highest levels it's ever been in this country. Now, kudos, we did have a little bit of a downtick in credit card debt, but we still at 1.12 trillion still represents the highest level we've ever been, right? Still way over where we need to be. So although a little slight downturn, not enough in my opinion. But then you wipe out all of that when you add another 9 billion in auto loan debt. Interest rates through the roof, but we still added we still added 9 billion in credit card debt. Who in the world are buying cars at between 7 and 21% interest rates? Who in the world buying cars with those type of interest rates? I don't get it. I don't get that part. You got interest rates, even with people with great credit scores. You're going to at least be a 7.5 on an interest rate on a new car. If you're a prime borrower, you're at 7.5. If you're a subprime borrower, you're between 14 and 21%. Now, who in the world would buy a car and finance it under those conditions? I don't know. Mortgage originations continued increasing at the same pace seen in the previous 3 quarters and now stands at 403 billion. Aggregate limits on credit card accounts increased modestly by 63 billion, representing a 1.3% increase from the previous quarter. Limits on HELOC grew by 30 billion and have grown by 14% over the past 2 years after 10 years of observed declines. So here's the thing, 10 years of declining in HELOCs. That means people were not using HELOCs, they wasn't taking out HELOCs. Now all of a sudden, people are. People are starting to take out HELOCs again, and it grew by 30 billion. Why are people taking more HELOCs out? Because that's what they're using as the safety net. People think, okay, I got all this equity in the house, I'm gonna use it. I ain't mad at them. Just be careful. Just be careful. Be careful you're using the HELOC for the right reason. See, if you got a money problem, your HELOC is not gonna solve that money problem, guys. If you got a money problem, your credit card is not gonna solve that money problem. It might put a temporary Band-Aid on it, but it's not gonna it's not gonna heal the wound. It's not. When you got a money problem, you got to solve your money problem by either making more money and keeping your expenses level, or you got to decrease drastically your expenses. It's the only way you get out of a money problem. You can't have I only got $3,000 a month coming in, but I'm spending 45. I'm going to go use my HELOC because that'll save me. No, because your HELOC going to run out at some point, and you still going to be making 3,000 and spending 45. See, when you got a money problem, you got to solve that money problem. You can't bring in a HELOC or your credit card or some personal loan to help you out of that. You got a money problem. You either make more money and manage your expenses better, or you sharply decrease your expenses so that you're living below the 3,000 a month. That's how you solve a money problem. And you change the way you think about money. How did I get myself in this trouble? Richard, how did you get yourself in this trouble? How did you get yourself in this trouble? Well, I got myself in this trouble because I'm out here buying things I have no business buying. I went and got this car that I had no business buying. I bought this house right after the pandemic because everybody else was doing it. I really shouldn't have did it. Yep, I done went on excess travel. Yep, I'm going out to eat too much. See, we cause these problems, but then we want to pin it on the government, or we want to pin it on somebody else. No, you the one going out to eat every night, not the government. You the one going out to eat every night. Ain't nobody forcing you from the government to go out and eat every night. Oh, it's Bidenomics. It's Bidenomics. It's Biden's fault. It ain't Biden's fault. It's your fault. No one's forcing you to go out to eat every night. No one's forcing you to take excess travel trips and vacations. No one's forcing you to go out and buy a car you know you shouldn't be buying. You made all those choices. And these are the consequences of these choices that we make as Americans. This $18 trillion in debt. Those are the consequences. So you got to pay the piper. You got to pay the piper at some point. And we're paying the piper right now. Question is, can we change this? Of course we can. But we're not going to change it till we have a better behavior with money. We're not going to change it until we fix our money problem. Our money problem is we spend too much. We are a nation of spenders and not savers. We have to change that. If we're willing to change that, we will be fine. But we got to be willing to change that, guys. We got to be willing to change our way of using our money. We don't have a problem with us making money. We got a problem because we spend too much money on stupid stuff. That's what we got a problem with. Aggregate delinquency rates increase. Remember I told you, it wasn't that the debts increased, the delinquency rates increased as well. And here we go. Aggregate delinquency rates increased in Q1 2024 with 3.2% of outstanding debt in some stage of delinquency at the end of March. So you got 3.2% of that 18 trillion delinquent. I don't know, some of y'all might say, oh, that ain't that bad. Oh, guys, that's a lot. We should be like under 1%, guys, if you really want to be honest. We should be like under 1%, not 3.2 and climbing. Somebody do the math on 3.2% of 18 trillion. How much is that? Here we go. Delinquency transition rates increased for all debt types. Annualized, approximately 8.9% of credit card balances and 7.9% of auto loans transitioned into delinquency. So now you got almost 9% of credit card balances are delinquent. You got almost 8% of auto loan balances are delinquent. Delinquency transition rates for mortgages increased by 0.3% points, yet remained low by historic standards. So really the mortgage debt thing is about the only one kind of stayed steady. But credit cards and auto loans, almost 10% apiece, increase in delinquencies. See, if you're not listening, you're not listening. But if you're listening, you understand what I'm saying. We got a problem in this country and it's getting worse. It's getting worse, guys. It really is. It is getting worse. From the New York Fed, aggregate household debt balances increased by 184 billion. Now we're up to almost 18 trillion and have increased by 3.5 trillion since the end of 2019, just before the pandemic. So you're talking about 2020, 2021, 2022, 2023, 4 years. In 4 years, we've added an additional $3.5 trillion in debt in this country. In 4 years. Wow. Compare that to any other country, and I guarantee you we wipe their clock. Just go compare it to any other country. Go compare that to any other country, and I tell you what, we're crushing. Aggregate delinquency rates increased in the first quarter as of 3.2%. 3.2% of outstanding debt was in some stage of delinquency, up 0.1 percentage point from the fourth quarter. Still, overall delinquency rates remain 1.5 lower than the fourth quarter of 2019. Credit quality of newly originated loans was steady, with 3% of mortgages and 16% of auto loans originated to borrowers with credit scores under 620, roughly unchanged for the fourth quarter. The median credit score for newly originated loans flat at 770, while the median credit score for newly originated auto loans was 4 points higher than the last quarter at 724. So overall, guys, we're in bad shape, in my opinion. Overall, we're in bad shape. We're not in good shape. When you look at $18 trillion in debt, it's up $3.5 trillion from just 4 years ago. That's not a great pace. Think about that pace where we're on right now, guys. If we extrapolate that pace out 20 years, what's going to be our debt? I mean, if you extrapolate that out over the next 20 years, so what's that? 5 more times, that probably will double. In the next 20 years, it'll probably double what we currently have. It'll probably be about 36 trillion, 36 to 40 trillion if we don't do something. Now, the question is whether you're going to do something, because you can't worry about your neighbor. You got to worry about you first. Once you get you buttoned down and hooked up and ready to go on the right financial pathway, then you can help others. But I love people out who are trying to help others who ain't even helped themselves. Help you first. Help yourself first. How do you help yourself? How do you get yourself in a situation where you can help yourself get out of this stuff? Number one thing is your income, guys. You got to sit down and look at your income and have a serious conversation with yourself. When you look at that income, then right beside that income, you should lay your expenses right next to it. So you should have your income right here and your expenses right here. And then what you got to start doing is you got to look at those expenses and you got to decide what's more important to you. You got to decide what's important to you. Because oftentimes when I sit down with people and we have this exercise where they tell me what their income is, and then they tell me what they spend their income on, 99% of the time, they always have stuff in there that they have no business having in there. Oh yeah, I guess you're right. I shouldn't have those streaming services in there. Yeah, I guess you're right. I shouldn't even have a category for entertainment. Why would I have a category in my expenses for entertainment when I'm living on more than what I make? Somebody help me out with that in the chat. What's the purpose of me having an entertainment category in my expenses? What am I entertaining myself for when I'm living on more than what I make? I shouldn't have no entertainment. Not nothing I gotta pay for. If I want to go take a walk outside or go to a free concert or something like that, maybe have a barbecue in the backyard where I go to the grocery store and pick up some food and I invite friends over and we have a barbecue. That, unless you call it that entertainment, but entertainment. I don't get this. You living on more than what you make, but you got a category in your budget for entertainment. See, this is where we're at in this country, some of us. Right? So you got to sit down, put that income down, put those expenses down, and then you got to say to yourself, am I living on more than what I make? If I'm living on more than what I make, then I got to look at my expenses. And I really got to go through those expenses and really start marking off things that shouldn't be there. Okay, let me go here. Let me go down my expenses. Entertainment, scratch. There is no entertainment that I got to pay for, so scratch that out. Barbershop 3 times a month, scratch. I shouldn't be going to the barbershop 3 times a month if I'm living on more than what I make. Scratch. Going out to eat, scratch. Trip to Cancun, scratch. All of that, scratch. And then once I eliminate all of those things that I shouldn't be spending money on, then I take another look at it. And I say, well, okay, here's my income. Here's my revised expenses where I've taken out streaming services. I've taken out all that crap. I've taken out the gym membership. I've taken out the hot yoga membership. I've taken all that out. Am I living on more than what I make? And if the answer is yes, then you got an income problem. You got to make more income. If you strip that thing down to the bare minimums and everything you got in those expenses are a actual need to live, then you got a money problem. You got to make more money. It's that simple, guys. That's the simple exercise we all should do. There is no investing in anything. There is no nothing until you right size that. Because your number one tool to build wealth is income. If you don't have any income, how are you going to build wealth? You can't. You cannot build wealth without income. Because you take that income and then you put it in something that will multiply it. So that would be my first step, guys. Here's the solution. Sit down with yourself. Put down all of your income. Put down all of those expenses. Go through and take out anything that don't make sense. And you know what I mean. Don't leave anything in there that ain't essential to living life. I mean, if I don't have my lights on, I can't live. If I don't have running water, I can't live. If I don't have food that I go to the grocery store and buy and bring home to cook, I can't live. I need shelter. Those are what I mean by essentials. I'm not mean, oh, I need shelter, but I'm going to pay $3,000 a month for an apartment. No, that's not, no, you don't need that. Oh, I need shelter, but I got this 5,000 square foot house with 6 bedrooms and 6 bathrooms, and it's just me and my spouse or my significant other, one child. But what if the rest of the family comes over? We need this. You don't need that, guys. You got to get rid of that house. Downsize. You don't need the $600, $700, $800, $900 a month car payment. You don't need it. Get rid of it. This debt thing is not going to change for any of us unless we make drastic financial moves, right? So that's the solution. I sit down, I look at my income, I look at my budget, I scratch out all the expenses that don't make sense, I downsize where necessary, and if I still don't have enough money, I got to go make more money. Whether that's through increasing my skill set so I add more value to the marketplace so I can get paid more, or I introduce some side hustles to my life. If I'm a teacher and I love teaching, but I'm not making a lot of money, but I'm not going to give up teaching because that's my calling. I love it. It's my passion. Don't give up teaching, but you need to add some side hustles. That's it, guys. That's the solution. If you want to get yourself out of this predicament, that is the solution. The solution is get yourself right sized, get yourself in a right financial shape. And you do that by looking at your income and having a strong, hard look at your expenses. And you get rid of these things that you know in your heart you don't need. I don't care what everybody on the outside world says about you. Stop letting pride keep you broke. Stop letting fear keep you broke. If you do that, then you put yourself in a position to free up valuable money that you could start investing in assets to build wealth. And that's how you get yourself out from under this mess that we're in the United States. If we all did that, we would still keep our economy running, but we also would reduce this debt. But the 1% want you in this debt. They want you confused. They want you thinking you deserve something. That way you'll stay in debt. Oh, I deserve this car. I deserve this house. I deserve that vacation. I deserve to go out 3 or 4 or 5 times a month and eat dinner at the finest restaurants. I deserve that Ruth Chris steak. I deserve it. See, they want you thinking like that. Because as long as they can keep you thinking like that, they'll keep you maxing out your credit cards. They'll keep you tapping into your HELOCs. They'll keep you buying these auto loans, these cars and getting these auto loans. They'll keep you in high interest rate credit card debt because you think you owe yourself something. Here's what you owe yourself. You owe yourself to build assets and create passive income so you can have more time, more freedom, and choices in your life. That's what you owe yourself. You owe yourself a lifestyle that you can lead and be comfortable in with your assets taking care of you so you don't have to work for the rest of your life. That's really what you owe yourself. All right, let's keep moving. Let's move into this next topic that we want to talk about. I touched on this a little bit yesterday. I thought this was a good piece of information to sort of piggyback on what I said yesterday. Yesterday, I talked about the real estate market, the commercial real estate market. That was the main topic. And we talked about how one of the large real estate investment trust companies is in trouble. It's a $10 billion company. It's a $10 billion company, and they're in trouble. They're in trouble. They have their investors asking for money, give me my money back, but they don't have the money to give them. They're in trouble. And this right here is a report where it went to the next level. It went to the next level. RXR defaults on a $315 million loan secured by 340 Madison Avenue in Manhattan, New York. See, this is what's happening. This is what's coming to the commercial real estate market. Why is that important to you and me? Because see, whatever happens in this commercial real estate market will trickle to the rest of the economy. It will trickle to the rest of this economy. And here's one of these examples where you have a $315 million loan that goes bad. Just telling you guys, it's a sign of times to come if we don't prepare. We got to prepare. Here we go. Boston-based lender, Mass Mutual, a subsidiary of Massachusetts Mutual Life Insurance, has filed a $315 million pre-foreclosure action against RXR and several partners for defaulting on a loan secured by the 340 Madison Avenue 22-story office building in Manhattan, New York. $315 million loan defaulted in New York, one of the priciest real estate markets in the world. RXR failed to pay off the senior loan at its scheduled maturity date of August 1, 2023. So it had a maturity. Remember, I had been talking about all along, guys, that there is $1 trillion in commercial real estate debt coming due in 2024 and 2025. I've been saying that for months. I've been reporting on that for months on these live streams. Here we go. I told you it was coming due. I told y'all it was coming due, and I'm telling you, if you ain't financially prepared for this, you're going to get run over by an 18-wheeler. Financial 18-wheeler is going to run over you if you're not ready for this. Because if you think this is not going to fall over into everything else in our economy, you don't know much about our economy. It's $1 trillion of this stuff coming due. Here's one right here. I reported you one yesterday. That was a $10 billion company that's in trouble. This is one loan for $315 million. RXR failed to pay off the senior loan at its scheduled maturity date of August 1, 2023, and failed to pay in February 2024 after receiving an extension from Mass Mutual. They sent them the default letter on February 5th. Even after written notices were sent to RXR, the firm still failed to pay the balance on the loan, leading Mass Mutual to seek a judgment of foreclosure and sell to foreclosure upon the property and sell it to pay off the loan. A complaint Mass Mutual filed May 17th in New York State Supreme Court. With almost 750,000 square feet and a 10,000 square foot amenity center, 340 Madison is a Class A complex, a block from Bryant Park in Midtown Manhattan, built in 1928. The property was fully renovated in 2006, while the lobby and entrance were renovated in 2020. Notable tenants include PNC Bank, Barings. Former tenants include Facebook. Big boy property. Going up on the chopping blocks. They're going to foreclose on these people unless they figure out a way to pay them off. Here's the problem. $315 million owed on the loan. There's no guarantee they get $315 million for the property. See, what happens is when these banks take these properties back, people know it's a situation where it was foreclosed on. No one really wants to pay your market value. Why? Because they know you got to get this thing off your books as fast as you can. Just saying, man. RXR and its principal partners, which include Athenaeus Capital, formerly known as USAA Real Estate, purchased the office building in July 2011 for $570 million and secured a loan for $305. Mass Mutual to do so, per legal records, the deal was among the first big Manhattan purchases for R&R, one of the borough's largest office owners, which was described by... See, the problem you're running into with these office buildings, guys, is they're empty. They're empty. I keep telling y'all, with these commercial real estate properties, everything is predicated on occupancy. And when these things start losing occupants and the vacancy goes up, ain't no income. The income starts drying up. The income starts drying up. And therefore, these loans get in trouble when the income starts drying up. In early 2023, that R&R won't throw good money after bad when assessing the firm's office portfolio. So they just decided not to pay him. The deal was among the first in Manhattan, one of the borough's largest. New York Post 13 years ago as a Uniondale, Long Island-based firm. The default on 340 Madison is the latest in a series of potentially strategic defaults by RXR. In early 2023, RXR won't throw money after bad money when assessing the firm's office portfolio. So they're making a strategic move just not to pay them. Okay, take the building back. What are you gonna do to us? Nothing. That's what they're doing. And ultimately, who pays the price for this? The American people. Ultimately, we pay the price for it. Ultimately, the people of New York are gonna pay the price for it. Right? Somebody got to cover that shortfall. Ultimately, we pay the price for it. We do. When these big projects like this default, guys, ultimately, we pay the price for it. Somebody gotta pay the price. And normally, it's us. Last spring, R&R nearly lost its 33-story office tower at 61 Broadway in the financial district after defaulting on a $240 million loan that matured on May 1. The deal is now being worked out. In November, the $670 million single asset, single borrower CMBS loan secured by 230 Park Avenue, also known as the Hemsley Building, transferred to special servicing on November 2nd due to imminent maturity default. So this R&R outfit, they got over $1 billion in real estate, man, right there. 3 properties right there that represent over $1 billion in real estate. That's a lot of money, guys. And here's the deal. Somebody got to pay the price for this. Somebody got to pay the price for this. R&R has inaugurated its strategic project Kodak, which has previously described as an attempt to divide the firm's assets between those buildings which are digital and worth keeping in the future, and those that firm considers film and worth walking away from. So this company, who has billions of dollars worth of real estate, they've made their decision that they're going to say, well, okay, we owe all this money. These buildings are worth keeping. These buildings are not worth keeping. So go pound sand. We're not going to pay you. So they take them to court. They sue them. They get the buildings back, the bank, and then the bank has to fire sell them. Somebody has to pay the price for that. It's just incredible to me. In this country, this is kind of what we do. We let these big boy banks, these big boy companies do whatever they want to do. They stop paying. They get to start over and do it again. We stop paying something. It follows us for a few years. I guarantee you this company right here ain't nothing gonna happen to them. They're gonna do exactly what they wanna do. They're gonna pay and keep the buildings they wanna keep. The rest of them, they're gonna let them go back. They're not gonna care, and they'll go back and do it over and over and over and over and over. And at some point, we pay the price for it. Whether we pay the price through higher rent, we pay the price through higher loan rates, we pay the price some kind of way for what they do. And it's wrong, but that's how this world works, right? And it's a non-recourse loan. So what does that mean? That means whoever the owners of these companies are, there's no recourse to them personally. 340 Madison is a building that we identified as a digital, high-quality building with a broken capital structure. What the hell does that mean? Said David Garton, senior advisor at RXR. We have been active discussions with the lender to restructure the $315 million loan, which is a non-recourse loan with no guarantor. These guys got a $315 million loan to some company. They got no guarantees on it. So that means if the company defaults on the loan, only people you can go after is that company, which is just a company. Can't go after the people who basically started the company. You can't hold them accountable because it's a non-recourse loan. But this is what they do at the big boy level, guys. This is exactly what they do at the big boy level, right? They buy these buildings, they buy these properties, they buy these multifamily properties. They deal in trillions, billions of dollars that they deal in. And then when it goes bad, we get stuck with it, with higher prices. Whether it be higher prices on rent, whether it be higher prices on it trickles down to our economy, right? So just be careful, guys. Again, you've got to get yourself in a position where you can protect yourself from this stuff. And you do that through assets. You do that through your income, being a good steward of that income, taking that income and start putting it into something that can multiply your wealth for you so you can get yourself out of this mess. I guarantee you these folks right here, this RXR, ain't nothing gonna happen to them. Nothing. This is how these guys roll. And they probably won't take the building. They'll probably restructure the loan for them, right? They probably won't. They probably will not default on the loan. And if they do, they're like, okay, oh well. We'll move on to the next one. We'll go buy the building down the street. Somebody will lend us the money. Why? Because banks are greedy. And guess who money they take? Guess who money Mass Mutual is using to loan them that money? Your money. Who do you think lent these guys, this RXR, all this money? Banks. And what do banks get money to lend to these kind of people? Us. They take our deposits. They take our deposits and they lend them to companies like this who just decide one day they're not going to pay it back. Just telling you guys, it's all connected dots. It all comes back to you and me. This commercial real estate stuff comes back to you and me because our money is the money our deposits are the money that's being used to lend these people money. These people bought a building in November, a $670 million single asset, single borrower CMBS loan secured by 230 Park Avenue. $670 million property. Wow. So there you go, man. There you go. It's crazy. One of our favorite, at least back in the day, one of our favorite restaurants back in the day, and I don't know, at least back in my day, Red Lobster was the place to be. I know a lot of y'all are, oh, Red Lobster, that's nasty. I would never go there. Back in the day, guys, I'm telling you, I'm talking about 30 years ago, Red Lobster was the place to be, at least where I come from. Y'all might be different. But where I come from, here in the South, Southwest Florida, back in the day, I'm talking about like the 90s, man, Red Lobster, that was the spot. Unfortunately, Red Lobster files for Chapter 11 bankruptcy protection. Old Red Lobster about to go out of business. Ain't that a shame? Because that's a company that's been around for a minute, right? That's one of the great restaurants, or at least used to be. Now, I don't know what it is to now. I don't go anymore. But back in the day, like I said, in the 90s, boy, you couldn't get better than Red Lobster. Not in the 90s. That was the place to be. Red Lobster has filed for Chapter 11 bankruptcy protection, continuing the process to shrink its footprint and find a buyer, the company said in a statement. The seafood chain also said it has a so-called stalking horse bid from its existing lenders to buy the company unless a bigger bid comes along. So the people whoever the lenders are have offered to buy the company, but it's a lowball offer, right? So they're trying to wait that out and see if they can get a better offer. CNBC reported last month Red Lobster was seeking a buyer, weighed down by significant debt and long-term leases. What did I tell y'all, guys? This commercial real estate thing is no joke. I keep telling y'all. What do you think they're talking about now? They're weighed down by debt and long-term leases. So throughout their footprint, they got these leases. But see, here's what's happening to them. Over the years, guess what happens? Sales go down. Sales start going down. People not going to Red Lobster like they used to. Sales are going down. But see, management doesn't see that. They think it's an anomaly. They think we'll right the ship. Don't worry about it. What they should have been doing in good times, they should have been forward thinking and saying, you know something, we got too many stores. We got too many restaurants. Let's start squeezing down this footprint and let's only operate in our most profitable cities. That's what they should have been doing. But nope, that ain't what they did. Now they're finna pay the piper, right? They're gonna pay the piper. The company recently appointed a restructuring expert, a managing partner with advisory firm Alvarez and Marisol, as its CEO. In a court filing, Tibis blamed a difficult macroeconomic environment, a bloated and underperforming restaurant footprint. What I just told y'all. Didn't I just tell you that? I just told y'all that. See, I already knew what was going on. See, that's management though. That's the people at the top. See, they fat rats making big money, flying in private jets, doing all this stupid stuff, ain't watching the business. They just think, okay, we're gonna keep rolling. Now all of a sudden you're in trouble. Now you're trying to shrink your footprint. Now you got these leases. Boy, I tell you, man, this is just so stupid, if you ask me. So stupid. In court filing, Tiberius, whoever he is, blamed a difficult macroeconomic environment, a bloated and underperforming restaurant footprint, failed or ill-advised strategic initiatives, and increased competition within the restaurant industry for the chain's need to file for Chapter 11 protection. Again, whose fault is that? The people at the top. Whoever the executive management team and the CEO at the top are the problems. You should have already had the foresight to start shrinking that footprint. You knew that. But he didn't. They didn't. Now you're in Chapter 11. The chain's real estate portfolio is also a huge problem. Duh. I already know that. I told y'all, we got $1 trillion in this real estate, commercial real estate. They fall into that category. They fall into that category. The chain's real estate portfolio is also a huge problem, created in part by Red Lobster's former owners, Golden Gate Capital, a source familiar with the company told CNBC, when Dartington Restaurants sold Red Lobster to the private equity firm in 2014. See, Darden Restaurants was smart. They were smart. They saw it coming. What did they do? They sold it. And what are they doing now? They're concentrating on their very best brands in their very best markets. That's what you got to do. You can't be everything to everybody in every market anymore. You can't do that no more. It's too much competition. So you got to focus in on your very best markets, and that's where your footprint is. That's it. But greed. See, greed is one of the 3 financial killers, and that's what got these guys. Greed. See, greed will do that to you. Greed won't allow you to see what's really out here in this real world facing you down the road. So that's what we got to be careful, guys. We can't allow greed to blind us like it did Red Lobster. Greed blinded these guys. Just pure greed. They should have saw this coming. Darden Restaurant saw it coming. They should have saw it coming, right? It fueled the $2.1 billion acquisition, partially through $1.5 billion sale leaseback agreements, the company said previously. Under the terms of the arrangement, the majority, if not all, of Red Lobster's locations were sold off, and the chain had to start paying rent on properties it once owned while Golden Gate reaped the profits. Crazy, man. The source said, at the time, it was tough to predict that Red Lobster would see sales drop. No, it wasn't. Come on, man. No, it wasn't. Y'all know none of these restaurants. Think about it, guys. Think about this. I'm talking about go back 10 years, 15 years, 20 years. Let's think about it. The Red Lobsters, the Outbacks, the Chili's, the Fridays, the Applebee's. Can y'all remember the day, guys, 20 years ago when these places served great quality food, great service? Could y'all remember that? See, I can remember back 20, 25 years ago when you went to Red Lobster, you got a big old plate full of good, fresh food. You fast forward now to today, guys, you go in one of them restaurants, man, they got these little bitty plates that look like little saucers. They got these little bitty plates. The food is terrible, and the prices are through the roof. Am I the only one that has noticed that? Am I the only one noticed when you go to these places now? I'm talking about staples, like when we were coming up for us older generation. These places were staples, man. You could go to Red Lobster, you could go to Outback and get the best steak in the world. Now you go to these places, man, they horrible. The service is horrible, the place dirty, the food is horrible, the prices are through the roof. It's just sad. It's sad. It's sad. But you're going to see more of this. You're going to see more of this, guys. You're going to see more of these Red Lobster type companies go out of business. Because see, now people have choices, and there's fierce competition out there. Fierce competition. And these people with these giant footprints, with these underperforming restaurants, terrible service, terrible food, that's what's going to happen to them. This is what's going to happen to them. Just incredible to me, right? Incredible. Just incredible. At the time, it was tough to predict that the Red Lobster would see sales drop as much as they have. Given how much revenue has fallen, the chain can no longer afford those leases. Red Lobster currently operates 551 locations in the U.S. and 27 restaurants in Canada. The chain closed 93 underperforming locations on May 13. They probably should have did that 2 years ago. They just did it. And the only reason they did it, they probably was forced to do it. But they should have did that probably 2 years ago. Probably should have did it before the pandemic, right? Should have been closing stores. And is asking the bankruptcy court to reject 108 of its leases to further slim down its footprint. So this Golden Gate company purchases them, right? And this is what the Golden Gate company does. They flip the script and say, y'all gonna pay us rent. The food chain gonna pay us rent because we own the real estate. You no longer own it. So pay us rent. And that's what's killing them, right? That's what's killing them, according to this. The company has 36,000 employees, most of whom work in part-time roles. What do you think gonna happen to a lot of them? They're going to be out of a job. That's what's going to happen. Orlando-based Red Lobster has assets between $1 billion and $10 billion, and estimated liabilities of $1 billion to $10 billion. According to the bankruptcy filing, its largest creditor is distributor Performance Food Group. That's who supplies them for their food. So they owe them a lot of money. That's who bring that. I don't even say that because I don't want to get sued. But that's the people who bring them the food. Which is claiming the company owes them $24 billion. Wow. This restructuring is the best path forward for Red Lobster, Tibbetts said in a statement late Sunday. It allows us to address several financial and operational challenges and emerge stronger and refocused on our growth. The support we've received from our lenders and vendors will help ensure that we can complete the sale process quickly and efficiently while remaining focused on our employees and our guests. I doubt that. I doubt you're focused on the employees and the guests, but it's good for the newspaper, I guess. Red Lobster was founded in 1968 and purchased by General Mills. 2 years later, it was founded in 1968 and purchased by General Mills 2 years later. In 1995, General Mills spun off its restaurant division into Darden, whatever it's called. These are the same people who own. They're the same people who own Outback Steakhouse and some of these other chains, right? So this same group. And I didn't know General Mills actually spun that off and actually owned it from the beginning. That's right, Darden Group. So they also own Olive Garden. That's another one, man. Remember Olive Garden back in the day? Whew. Man, Olive Garden was good back in the day. Now, good luck. Nearly 2 decades later, Darden sold Red Lobster to Golden Gate in 2016. Thai Union Group, a seafood supplier and one of the chain's longtime vendors, bought a stake in the company in 2020. The Thai Union members of Red Lobster management investors using the alias Seafood Alliance bought out Golden Gate's remaining stake in the chain. Although Red Lobster survived the pandemic, its business has struggled since then. The chain's traffic has tumbled about 30% since 2019. I ain't no surprise to me because I'm telling you guys, these restaurants ain't like they used to be. The company's longtime CEO also retired in 2021. That's probably where a lot of the problems started, beginning a revolving door of CEOs that left the chain with little stability to turn around the fledgling business. Tibbetts, a Red Lobster's third chief executive in as many years, in fiscal 2023, the company reported a net loss of $76 million. Goodness gracious. Some of that loss was driven by disastrous endless shrimp promotion. All right, that's enough, man. That's enough. One of the great restaurants of my younger days is going down like the Titanic. And it's the same, but it's not surprising. Last thing we're gonna cover, guys, and we're gonna get on out of here is we're gonna cover a little bit of the stock market because of course I believe this is an opportunity right now for a lot of us to really double down and level up our wealth by using paper assets. So I like to I like to include in every live stream some information about the stock market because you guys know I'm heavy into the stock market. I'm heavy into the stock market. 75% of my net worth is in the stock market. And it's done well over the last 30 years. So I love to cover the stock market as one of the big three ways that you can put your money into something and multiply it. Stock market being one through paper assets, real estate for income, and then businesses. Those are the 3 ways you can multiply money today to get yourself to your pot of gold at the end of the rainbow. And for those of you that want to focus more on paper assets and building your wealth through buying ETFs and individual stocks, then get down to the description box, click on that Moomoo link. Open up your new Moomoo account today. You put $100 in your new Moomoo account. They're going to give you 10 free fractional shares of the Magnificent 7 stocks. That's all you got to do, and you can get started today. So let's dive into some of this right here. It says NASDAQ falls. pulls back from record highs. So yesterday, guys, and the day before, or not the day before, but the week before. So yesterday was Monday, and then the last week, the stock market went on a tear. It went on a tear. It went on a tear because optimism and FOMO returned to the market on Wednesday of last week, the 15th, when we came out with the April CPI inflation report, and it was great news. It showed that inflation was not gaining ground anymore. It was actually losing ground and coming down slightly. That was good news. Coupled with the jobs report from April was great news as well. It showed that the labor market was cooling off. We were not adding as many jobs as we added in the first 3 months of the year. The fourth month of the year, we saw a downtick. We also saw an uptick in unemployment. So those are all good things for the Fed, because the Fed is saying, listen, we got the labor market needs to soften, and we also need to see inflation coming down before we'll reduce short-term interest rates. Last week helped. So then you saw the market go on a little bit of a rally. The first time in 139 years, the Dow hit 40,000 points. First time in 139 years, guys. So we are in a position where we had a great week last week, but it cooled off a little bit. The NASDAQ composite fell sharply on Tuesday, easing from the record levels seen in the previous session. So it cooled off a little bit. As Nvidia dipped a day before its key earnings report, you even had 900-pound gorilla AI chip maker Nvidia lost a little bit of ground this morning. Yesterday, it closed around $9.47 a share. It lost some ground this morning. I don't know what it's doing right now, but it did lose ground this morning. I think that's temporary, though. I think tomorrow we're going to see, after the bell rings tomorrow, when Nvidia reports its first Q1 earnings, I think we're going to see monster earnings. And I think we'll send Nvidia to the moon. That's my opinion. I'm not your financial advisor. I'm not trying to tell you to go buy Nvidia. I'm just telling you what my opinion is. And I got to be transparent. I have a position in Nvidia already that have already taken out. My position is there, and I'm waiting on the run. Just so I'm transparent, right? Nvidia dipped the day before the key earnings report. The tech-heavy benchmark lost 0.2%. The Dow pulled back marginally, while the S&P slipped 0.1%. Nvidia shares pulled back 1% prior to its earnings report Wednesday after the close. Analysts are expecting the semiconductor giant to post another strong batch of results. I do too, by the way. And I can't wait. Palo Alto Networks also dropped roughly 6% on Tuesday. Now, that might be an opportunity for somebody who understands and knows about Palo Alto Networks. You got a 6% discount here. You even got a slight discount on Nvidia right now. Now, let's go see what Nvidia is doing right now. Let's take a peek, because I'm curious to know what they're doing as the day progresses with trading. Let's see what they're doing. Okay, they're slightly back up a little bit, because when I looked at it earlier, they were in that 937 range. Now they're up to 946. I'm telling you guys, in my opinion, we got a run coming on the video. Again, not your financial advisor, not trying to give you financial advice. I'm just telling you, I think it's a run coming. And I'm already positioned and ready to go, so I'm in good shape. While beating expectations for both lines in the fiscal third quarter, the cybersecurity company, which they're talking about Palo Alto Networks, the cybersecurity company delivered current quarter guidance that was only in line with consensus forecasts for analysts polled by LSEG. So there may be an opportunity there. I don't know that company, but they're at a discount right now. Maybe an opportunity there. We'll have to see. Those moves come after a mixed day on Wall Street. The NASDAQ notched to intraday and closing records while the Dow fell on the back of steep declines in JP Morgan Chase shares. What in the heck is going on with JP Morgan Chase shares? That's another great company. Another great company. Traders now turn their attention to commentary from Federal Reserve officials. Fed Governor Christopher Waller said he wants to see several months of supportive inflation data before lowering rates. Y'all know that was coming. I had said that they want to see at least a couple months. You know, they meet again, what? June 11th and 12th. That's when the Fed will be meeting again. And here's the thing. If we can get a May report with that April report, then I think we're in good shape for rate reduction. But just like the Fed Governor Waller said, they need to see several months. And that's not a surprise. The key is they still haven't said they're taking rate cuts off the table. That's what we don't want to hear. Long as we don't hear that, we're good, guys, in the stock market, in my opinion. We are going to be good. Richmond Fed President Tom Barkin and Atlanta Fed President Raphael Bostic are also due to speak. The disinflation story is still intact, said Keith Buchanan, portfolio manager of Global Whatever Investments. The market's going to continue to drift higher if earnings can confirm the stickiness of the corporate profitability. He added, but that could lead to a market where we could be somewhat range bound, perhaps even drift lower. I think tomorrow is going to be a big day. I think it's going to be a big day. I think it's going to be a big day, guys. So put yourself in position. That's all I can tell you. All I can tell you, guys, is put yourself in position. I think it's going to be a big day tomorrow. I think when the video comes out, I saw one report where they say, you know, the stock price could swing $200 billion tomorrow or tomorrow night, because they're not going to report till after the bell. So maybe Thursday morning. I don't know if that's true, but they're saying it could swing the stock price $200 billion. Like I told you, I got to get my little piece. I got to get my little piece. I'm positioned. I'm ready to go. I got my little piece. I need my little piece. So we'll see what happens. We'll see. The question is, all this information we covered today, are you prepared? I'll end it with this. Are you prepared? That's my question to you. Are you prepared to weather any storm? Are you prepared? Are your finances in order? Are you living on less than what you make? Are you living on a plan, which is a personal budget, which is your financial Bible? Are you living on that? Are you keeping yourself out of consumer debt? Or do you fall in the category with these other folks who have accumulated almost $18 trillion in debt here in the US, where we lead the world, by the way? And then the last one, which is most important, are you saving and investing for your future? Do you have your 3 to 6 months emergency fund tucked away? And then are you investing in assets to build wealth, like paper assets, like the Magnificent Seven, like an S&P 500 ETF, like an information technology or a healthcare ETF? What are you doing? What are you doing to multiply your money so you don't have to do anything? Right now, you're trading this time for money, but you only get that money unless you trade that time. At some point, you ain't gonna want to trade time no more. What are you gonna do? Do you have enough assets tucked away that'll generate enough income to replace your income over here when you no longer want to work for somebody? Do you have enough assets to replace that income? These are all questions you should be asking yourself, guys. And if you're not comfortable with your answers, you need to put a plan together to get comfortable and get yourself to wealth. Again, guys, drop down in the description box, click on that Moomoo link, open up your new Moomoo account today, put $100 in that Moomoo account. You're going to get 10 free fractional shares of the Magnificent 7 stocks. And now you're ready to put yourself in a position to start buying paper assets like they just talked about, so you can start building your wealth. Go get that free stock, man. Go get that free money. Moomoo is my brokerage app that I use. That's my primary brokerage app that I use. And I'm going to use it for the next 10 years to build wealth through buying paper assets, S&P 500 ETF, information technology ETF, the Magnificent 7. That's the 3 investments I'm going to be buying using my Moomoo brokerage account over the next 10 years. Why don't you come join me? Why don't you get on the team? Get down in that description box, click on that Moomoo link, get those free stocks, and then send me an email and say, hey, Richard, I opened my Moomoo account. I put my money in there. Send me the Moomoo tutorial video to walk me through how to use the Moomoo app. Also, send me your wealth transfer blueprint that outlines those 3 big boy blue chip paper assets you're buying over the next 10 years. Send me that information so that I can get myself off to a good start. And I'll be more than happy to send you that information. All you got to do is just email me. My email address is down in the description box. Don't forget, guys, the only way we change something in our financial life is if we change it. We got to execute. Why don't you start executing today? Get down in that description box and get that Moomoo link and get yourself a Moomoo account set up and start executing. Make sure you also go check out the website, www.richardfain.net. That's the new website. It has great digital products that can help you collapse time frames and get you to your freedom faster. Go check out the website. And while you're over in the website, sign up for the mentorship club that I have. We almost got about 350 members in there, and it's rocking and rolling, guys. We're having a good time. We're learning a lot. We're supporting each other. It's our own little family, and I love it. I love it. I love it. So we would love for you to join us. If you want to, get to the website. It's the second link down in the description box. The website is the second link, www.richardfain.net. We would love for you to become a part of our family, our mentorship club family. If you want to be a part of the family where you'll have me there 7 days a week, 365 days a year, helping you get to your financial freedom, come join the family. Come join the mentorship club. We'd love to have you. Well, guys, last thing, get down to the description box and click on that Instagram link. I need some followers on Instagram, guys. I'm trying to get this new Instagram page where the old one was. I don't know if I'll ever get back to the 90,000 followers I had on the old Instagram page, but I'm going to try. Right now, I got about 3,500. I need your support. I need your help. So if you are an Instagram person and you rock with Instagram, I need you to rock with me. I need you to get down to the description box and click on that Richard Fain Millionaire Mentor Instagram link. Give me a follow and then send me a DM to let me know you're rocking with me. And I can say thank you. Appreciate y'all today, guys. Y'all have been wonderful. I hope you learned something. You know I'll be back tomorrow at 10:30 a.m. Eastern time with more financial information to help you do what? Collapse time frames, get your mindset right, and execute. Collapse time frames, get your mind right, and execute. That's what we do, right? We collapse time frames, we get our mind right, and we execute. So you got to be here every day. Be here every day to join me to help you do that. All right? Well, I appreciate y'all, guys. Lock it in with a thumbs up before you get out of here. Y'all know the thumbs up. I got to have it. I need the thumbs up. That just lets me know I'm doing a good job. That's all it does. It gives me a sense of, Richard, what you're doing is the right thing. See, I need a little bit of praise too, guys. I need a little bit of that a boy. And that thumbs up will let me know y'all rocking with me and y'all appreciate what I'm doing here every day. Because I'm coming at you every day, 365 days a year. And I love it. But I also need a little bit of a, hey, Richard, you're doing the right thing. We appreciate it. And the way I ask you guys to do that is to hit that thumbs up button for me. So before you lock out of here and get out of here and go on with the rest of your day, hit that thumbs up for me. I really would appreciate it. Thoughts become things. You can see it in your mind. You can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy. Get wealthy. And I'm going to catch you guys on the next one. Peace.